Welcome back, everyone. The next presentation will be from Raymond Wang, CEO and President of Greenland Technologies, that trades on the NASDAQ under GTEC. So, welcome.
Very much. Thank you very much, everyone. It's an honor to be here. Wanted to thank Water Tower for inviting me to this conference, and for everyone in person and on the call for taking your time to learn a little bit more about Greenland Technologies. So, in a summary, Greenland Technologies, we are a public company on the NASDAQ. We trade under company symbol GTEC, and our business is comprised of two core business units. We have our Zhongcai machinery business, which is what we started the company with back in 2006, and we are the leading manufacturer of drivetrains and transmissions for forklifts and other material handling vehicles. Then our newest business unit is HEVI Corp, which is based out of Delaware and headquartered in New Jersey. And the mission of HEVI is to manufacture all electric sustainable construction equipment to the United States market. And it is the first player to do so, so it is a pioneer in this space. And combined together, GTEC will produce about $100 million in revenue, about $20 million in profit per year. At this stage, primarily through our core transmission business, and it's been rocking and rolling doing that since 2006 as a market leader in our space. From a quick stock standpoint, we actually have right around 13 million shares outstanding, about 3 million on the public float. And with our current share price right about at 2.5 to 3, it puts our market cap at about $30 million. The one thing I just want to throw out there is the fact that at this stage, we're sitting on a little over $20 million in cash. So we are trading at cash value. And in my opinion, to say that we are undervalued at this stage is an understatement. But let's talk a little bit about how we got here. So as I mentioned, Greenland Technologies, we started in 2006 with our Zhongcai machinery business unit in a humble facility overseas in China. And our mission was to produce the highest quality components that we could. We wanted to be a leading and premier player in the material handling manufacturing industry. So we focused exactly on that mission, and this is a key principle that is part of the Greenland culture, which is focus. And after a few years of sustainable growth, of expansion of our service, we established our brand, we penetrated the market, and then we became the premier manufacturer of high precision gears that's used in drivetrains and transmissions. Then, right around 2010 to 2011 timeframe, we took our expertise and then continued to move a little further up the chain to then produce our own drivetrain and transmission units. And we continued in that business until we mastered it, captured market-leading status in right around 2016, expanded our manufacturing capabilities to suit that demand, and then we continued to move further up the chain to produce drivetrains for not just forklifts, but then other material handling products such as large external logging and forestry machinery, light commercial EV products, and even military applications. Then we joined the company, we joined the NASDAQ in 2019 via SPAC. We did it before it became the flavor of the month. So I always like to say that we were the model on the street on what to do and what not to do with SPACs. But that is how we joined the NASDAQ. Just like with anything in business, we adapt and we made the best of it. And right now we are trading at the levels that I mentioned a little earlier. This is also when I joined the company as CEO in 2019 and introduced my mission to continue to further expand the business capabilities of Greenland. At this stage, we're already market leader in the manufacture of components of transmissions and drivetrains. So I wanted to take the company to the next evolution, which is to become an OEM ourselves. And we're not another Me Too player. That's not how we've achieved success with Greenland over time. So we wanted to take our manufacturing and innovative principles to apply electrification in a field that no one else was playing in. And this is heavy duty construction equipment. I'll get into details a little bit about what I mean by that, but we introduced HEVI Corp as a wholly owned subsidiary, specifically with this focus to electrify this industry. And we launched our first product line in 2022. We have all electric products that range in size from 12,000 pounds to 40,000 pounds. So definitely not something you'd see in front of a Home Depot. This is true electric assets to make job sites across America much cleaner. And that takes us to where we are today. So I'm not going to dive too much into the product evolution. Wanted to explain a little bit about our core products. Don't worry, I'm not going to bore you with every single product we make. We do over 44 different series, each with between half a dozen to a dozen models. So if I were to do that, I'd take up more than all of the time I have and everyone would be asleep. So the only thing I want to call out is the drivetrain on the upper right, because it really showcases the innovation and offering we provide to our clients. So what that unit is an integrated drivetrain specifically catered towards lithium-powered forklifts. What we did is we took the three most difficult components for a lithium-powered forklift, the electric motor, the speed reduction gearbox, and the driving axle, and popped it into a single unit, a single package that an OEM looking to make their own lithium-powered forklifts can take that and pop that in. It cuts their development time by about 60%. Now, I bring that up because this product line, we're extremely proud that it truly pioneered and launched the adoption of lithium-powered forklifts on a global scale. This product powers the world's leader in lithium-powered forklifts today and is inside right now over 24 different brands around the world. This product line also, on our side, earns us a 30 to 35% margin. And in the component industry, that is unheard of. Most folks would be happy just getting to 9 or 10%. This is doing 30. And this showcases the capability on what we are able to provide to our clients and then to the company and our shareholders. The market leading status of our component business allows us to continue to grow as the global demand of forklifts continues to grow. Right now, depending on who you ask, it's going to be between 8 to 12% compound annual growth rate. And as a market leader in our space, as the industry continues to grow to try to meet the demands of e-commerce, Greenland is going to continue to grow with it as well. Right now, we'll sell about 180,000 units per year. That's produced and delivered, producing about $100 million in revenue. And with our focus on improved margins, that continues to grow, so our profits continue to grow with it. This is where the magic happens. We have about a 700,000 square foot facility overseas in China. It's outside of Shanghai by about 2 hours. Our subsidiary, Zhongcai Machinery, is labeled a high technology enterprise overseas in China. So even in the landscape of manufacturing overseas in China, we are labeled the cream of the crop of that. This affords us with a advantage on our tax rates across the board, and it allows us to borrow any money we need to support our operations, such as buying raw material to produce and fulfill on our contracts at extremely, extremely favorable rates. And this site has the capability right now, as is, to produce over 400,000 drivetrain units. As I mentioned, right now, we're actually producing about 200,000, about 170 to 200,000 to meet demand. So we already have the capability to continue to grow to meet the global demands of material handling around the world. This is what allows us to cater to all of the tier 1 brands in the material handling industry, from Linde, Hitachi, Toyota, BYD, just to name a few. Right now, we support over 100 different OEMs around the world, and we cater towards long-term established brands. We're not a onesie, twosie. We are the premier player on the block. We actually are the most expensive product on the block, but we are the largest because our statement that we are a market leader is not PR, it's not marketing. This is our stance. We're able to push the products that we can and enjoy the margins that we have because we have that status, we have the reputation to serve these tier 1 clients around the world, and they trust us because we are the only ones that have the manufacturing capability to make these highly complex products at scale with the quality that they can put their brands behind and the innovative talent to introduce new product lines for them to help them maintain their leadership status for their respective markets. And that's our component side of the business. But let me shift over to HEVI Corp. And unfortunately, this is a site that we are all too familiar with, especially here in New York City. Just walking over here and from Chambers Street to where we're located today in Vesey, I already walked by 4 construction sites, each operating heavy equipment, billowing massive plumes of smoke right around our schools, the universities, and our residential areas. Right now, this has been diesel for over a century. The only thing that came before diesel power was steam back in the 1900s. There is no available option today for any company looking to have a cleaner job site until HEVI came around. So from a demand standpoint, from a timing standpoint, right now, on a global scale, everyone is comfortable and believes in the benefits of reducing carbon emissions produced by passenger cars. And each car, according to the EPA, will produce about 5 tons of CO2 per year. Now, most recently, there's a big focus on electrifying transit buses, school buses, MTA buses, whatever have you. There's about between 150 to 200,000 buses operating in the United States at any given moment, each producing about 35 tons of CO2 per year. Major producer. And the next stage, the next application to really move the needle on reducing carbon emissions and NOx as well, which is going to be a focus in the next few years, is going to be heavy construction equipment. A small size, compact loader, which is that Caterpillar product you see right there. A compact one, right around 10 to 12,000 pounds, will utilize about 4 gallons of diesel per hour of operation. And those are advertised brand new off the lot rates. That, though, taking that value, will produce over 90 tons of CO2 per year. 90 tons. You need 26 acres of forestry to offset that carbon for one compact vehicle. Majority of heavy equipment, though, used aren't compact. They're going to be full-size units over 40,000 pounds, burning upwards of 8 to 10 gallons of diesel per hour. And unlike transit buses, at any given moment, there's about 1.2 to 1.5 million pieces of heavy equipment being operated in the United States alone. So the more of these heavy equipment products that we can switch over to cleaner technologies, the more we can move the needle to offset emissions and have a cleaner community for ourselves, our neighbors, and our families. From an opportunity standpoint, I always like to focus on the forklift industry because with our own side business, that's kind of our bread and butter. But over time, for over $50 billion a year industry, growing at a very healthy compound annual growth rate, right now it's already gone through the transition and evolution from fossil fuel and propane over to electric. Overseas in markets like in China, in Europe, right now about 9 out of 10 forklifts sold are already electric. And of that amount, over 85% are lithium powered today. Now, here in the US, we are a little bit behind on it, but we've already seen a dramatic swing towards it. Right now in the United States, about 1 out of 2 forklifts sold are electric. And at the moment, about 70% of those are lead acid, but lithium is going to convert over very rapidly. The reason being is our market leader with electric forklifts is maintaining that technology as long as they can before they have to switch over. But they have the capability to do so at any given notice, so it's just a matter of time. But we switch over to just a subset of the heavy equipment industry, front loaders and excavators, which just happens to align with our initial product line launch, but I digress. Those two combined are about a $70 billion a year industry, and as I mentioned, there is no option available outside of diesel. So from an electric market share standpoint, I'd love to put 0, but it's practically no. If you were to try to buy any type of non-diesel product in that space, you're stuck. You have no options today. But the demand is there for it, and we will start seeing the construction heavy equipment industry begin to follow the forklift and other material handling industries as well for cleaner technologies for adoption. And the reason being is because from a ESG and sustainability standpoint, this is becoming ever more adopted from both a country standpoint and a company standpoint. These slides are a little outdated, but right now over 1,000 public companies on a public exchange have embraced decarbonization targets as part of their company values and ethos. From a country standpoint, right now, over 100 different companies have set net zero emission targets. And right now, I think it's about 60, a little under 60, have actually put that into law. Whereas from a technology and capability standpoint, the reason why we continue to see more adoption and more applications for electrification is the cost to electrify these product lines continues to fall. We started in 2010 with passenger cars. Most recently, we've seen transit buses and applications switch over to electric. And now we're at the stage where electric heavy equipment are sustainable for adoption for businesses. And this follows exactly what the wonderful company SES that followed me prior was showcasing as well. The technology continues to advance and the cost and economics for it continues to become more and more attractive. And this is what we are entering the market with. So at 2022, HEVI launched its first line of all-electric heavy equipment. We have 3 units, these 2 front loaders and 1 excavator, that ranging size from 12,000 pounds all the way up to 40,000 pounds. That GEL 5000, that's my son's favorite because it is 40,000 pounds, about 14 feet tall, and that's a 4 cubic yard bucket. So he always jokes that that's going to become his bedrooms because it's bigger. These are machines designed to do work. Each machine can operate for over 9 hours on a single charge because these are business assets. If it can't do 9 hours, then they're really just a toy. To do that, they're powered by a LFP battery that we source from CATL right now, from CATL, the world's leader in battery manufacturing, the same batteries in Tesla, Ford, GM. That's what allows us to do so. That GEL 5000 uses a battery that's nearly 2.5 tons in size, but you need that power to be able to give it that 9 hours of life. And with these product lines, they're extremely cost effective, which I'll dive into in just a little bit later, but their maintenance is significantly lower. We know from the passenger car industry, it's well adopted that electric versions are going to have 40% less maintenance compared to their gasoline equivalents. We actually see our equipment having about a 60 to 80% reduction in maintenance because thankfully no one's taking our loaders 90 on the highway, so we don't have to deal with that wear and tear for our electrical systems. And this is one of the challenges for our product line in this traditional model of selling and distributing product through a dealership approach. Because especially in our industry where right to repair is such a critical issue, and that's because it defends one of the largest revenue streams for a standard dealer, which is the maintenance and repair capabilities. Our products would never see the light of day on a dealership lot because of that. They're not going to sell electric and take a 60 to 80% pay cut when they can continue to sell diesel. I bring this up because we are following a direct sales model. And to do so, to properly service it, our business focus is entirely right now on the Mid-Atlantic region of the United States. The reason being is, as I mentioned, from a culture standpoint, to succeed, we need to focus our efforts. So instead of trying to capture the world, instead of trying to capture the United States all at once, right now, we are focusing on penetrating and establishing our brand in the Mid-Atlantic region first. We define that from southern Connecticut all the way up to the Virginia, Washington, D.C. area. Once we penetrate this market, capture market share right about 2 to 3%, then we'll push over to the South Atlantic, then we'll leapfrog over to the West Coast, and then we'll come back to Central on 2 fronts. And this is how we're going to succeed. This also allows us to disrupt the industry because unlike other product lines or standard purchasing process today, to have the pricing for a piece of equipment is very, very difficult to obtain. You have to jump over a lot of hurdles, make a lot of phone calls, even just to get a price quote. But we can be upfront about it. There's no gimmicks, there's no hidden fees, nothing. We actually put our price right there for any interested prospect looking for our equipment. I will dive into the pricing in a little bit, but I will say right now, just to set expectations, the pricing that you see here are comparable to their equivalent diesel. We do not charge a premium for our equipment. We won't get adoption without it. So there's no premium on our equipment. Anyone looking to consider cleaner options for their job sites and for their operations won't have to worry as much about the bottom line. Now, where are our products best suited for? So first thing, let's talk about the benefits itself. Because our products are all electric, they have a very small carbon footprint. There's no operating emissions. So let's say if you're doing work in a salt silo, inside a greenhouse to clean up produce, or inside a livestock barn to clean the barns, load feed into the hoppers, or inside of a recycling center indoors. You don't have to worry about putting big respiratory units to pump out the emissions and not harm your employees and the neighboring area. There's no emissions at all. Plus, also, you don't have to worry about the emissions affecting the quality of your assets or products in the case of agriculture. Our products are bone quiet. One of our fun tasks that we do when we give demos for our equipment is we walk around, we talk about the features, and then once we've done a lap around the machinery, I jump inside, move it, and it shocks everyone. Because if you've been around diesel heavy equipment, you know you can't be next to it and even have a conversation, much less not know in arm's reach that it was on. So this makes it wonderful for applications from a safety standpoint. They're simple to use. If you're that rural farmer operating pieces of equipment, you no longer have to worry about buying, transporting, and storing fuel on your farm. You have your charger, you plug it in, you use it during the day, plug it in overnight, and it's ready to go the next day. Couldn't be any simpler than that. And they're very simple to maintain. As I mentioned, no more spark plugs, no more filters, belts, none of that. And this leads to a significant savings from a fuel standpoint, which I'll get into in a little bit. But as I mentioned, a piece of heavy equipment will burn between, let's say, 4 to 8 gallons of diesel right off the lot. Diesel right now is right around $5, $6, $6 here in New York City, $5 in New Jersey. My mother lives in California. You don't even want to hear those rates. Whereas from an electricity standpoint in our area, it's about 7 to 11 cents a kilowatt hour. So it takes only about $4 to $6 per hour to operate our equipment. Major savings there for a business. And this makes it perfect for many types of yard applications. These are applications where this machinery always has access to electricity, is not leaving that site, like waste management, property management, public works yards, manufacturing, agriculture, and the list goes on. A little example of our equipment working some salt, which actually is a wonderful example because right now from an EPA standpoint, we're finding that salt in our regions is a source of fossil fuels getting to our waterways. How? Because we store salt in silos. We utilize heavy emission diesel equipment to maintain those salt silos, load them up. This whole time it's trudging around, producing emissions, having fossil fuel spillage. The salt just sucks up. We put it into our plows, they dump it on our roads, and when the salt melts, it just melts it into our waterways, and then you see oil slicks after every snowstorm. But with our equipment, that entirely eliminates that. And cleaner waterways, this is better for all of us. Now, from a cost saving standpoint, this is the biggest way on how we get interest first, because these are business assets. We're selling to organizations. These aren't emotional, leisurely sales like a Tesla Roadster for certain lucky individuals. So to get people interested to consider new technologies, we had to make it make sense on paper. So as I mentioned, there's no sticker shock, there's no premium for our equipment. Factor in the maintenance savings of between 60 to 80%. This table uses 40% to be conservative. Then from a fuel standpoint, that's the biggest savings. Combine that all together for our 40,000 pound loader, a business's looking to save $70,000 year one by adopting our equipment. And then from there, we can have the conversation about the environmental benefits and the operational benefits to integrate our product. And right now, there's over a million pieces of heavy equipment. It's a $200 billion a year industry. And if we are successful in converting these diesel products over to electric applications, this shows the growth opportunity for what we're trying to do here. Now, for the sake of time, I'm actually just going to jump to a quick summary about Greenland itself. Because just to wrap things up, from Greenland itself, we have our core component business that's producing about $100 million in revenue, about $20 million in profit, and consistently growing. It's been profitable since 2007, the first year practically that we started. This provides significant value to our shareholders. Couple that with the growth potential of HEVI, where we have first mover advantage on a $200 billion a year industry. Should we succeed in penetrating this market and even capturing just 2% of that, which that's the level where we think we can maintain first mover advantage before we see any true competition for the next 7 years, then we've provided significant value to both our company, our clients, and our shareholders. And in a nutshell, that's Greenland Technologies.
Raymond, thank you very much. I didn't mean to cut you off 2 minutes ago. Great presentation. I wanted to go to the room, see if there are any questions from anyone. All right, wonderful. We have just time for about a minute, one or two.
Just quick. Could you just talk about your sales traction on the HEVI side?
Yep. Absolutely. So we've gotten significant interest for our product line, being it's the only available option today in the United States. Our focus right now in establishing our brand and penetrating the market is achieving fleet sales, pilots, and demos with national brand companies. So this way, one of the questions we often get asked is, who's utilizing your equipment? I can say, hey, this national brand rental company is using 20 of them. They're loving it. That has more value than if I say, Joe's Landscaping down the street utilizing one. But the way that we actually sell our equipment is through live demos. We stand by our product, and instead of us talking about it, we give them the keys, we bring it to their lot and say, do work, have fun, let us know the feedback. And we've gotten some tremendous, wonderful feedback and interest in our product line.
Quick question on your first mover advantage and your ability to capture market share. There are established players in the construction industry, construction equipment particularly. Do you see them getting into this field already? Are they about to? Can you talk about the competitive landscape, let's say 3 years from now? And what do you see, not so much from the smaller companies like yourself who are trying to establish market share, but from current leaders who are maybe looking to switch to a battery-powered construction equipment or mining equipment?
So with the market leaders today, the big players, if they had their wish, it would never switch over to electric. The reason being is because it completely disrupts their business model. We see that in the passenger car industry today. Toyota, Volkswagen, BMW, they all had electric versions of their cars back in the 90s. They'd parade them around the car shows, show that they're sustainable, but you couldn't buy them. It wasn't until a player Tesla came in, converted 2 to 3% of the industry over to electric to force them to come in. And they're still trying to figure out how to sell their equipment. GM is subsidizing a lot of their dealers to try to push it, but it's still practically hidden on their lots. If you're GM, then you bypass the dealers, sell online, but what kind of message does that send to your dealership force? And it's a challenge, it's a struggle, it's a Pandora's box that they would never open if they can avoid it. If we look at Caterpillar, their last earnings, they have a $24 billion a year backlog on their diesel equipment, and that's an improvement. It went up to a height of $96 billion during COVID when they had significant supply constraints. There's no interest for them to switch that over to electric, cannibalize their business, and then earn 60 to 80% less in just maintenance parts alone, which is the major revenue stream for their dealership. So if they had their way, never go over. Very quickly, for smaller players like us, the standard flow is they're going to start with smaller product lines. You're going to see skid steers, mini excavators, products that are about 1 to 2 tons in size over the next 1 to 3 years. You're already seeing them in CES. Bobcat actually did a launch that failed, but that's another story. You're going to see that. They're going to establish the market share there because it's easier to prototype. Then they're going to get their manufacturing in order from 3 to 5 years. And it's going to take to that level before they can expand into ours. So that's the 7-year runway. Because we already have the manufacturing capabilities, that allows us to jump right into it.
Raymond, thank you very much. Unfortunately, we are at time. If you have any other questions, please approach Raymond.
Thank you.